The bond market is about to shake the foundations of the entire economy. Right now, something is unfolding that nobody's paying attention to, and it could shake the entire economy. Here's the catch. It's eerily quiet. The 10-year yield is stuck in its tightest range in over 30 years. But why does this matter? How could this hidden shift completely change the direction of the markets and your investments without warning? Stay with me, because what happens in the next few months could change everything you thought you knew about the markets. This isn't just a random blip on the radar. What we're seeing in the bond market is part of a larger pattern that's been building for months, a quiet before the storm. And if history tells us anything, when the 10-year yield gets this tight, it's a warning shot for bigger moves ahead, moves that could rattle the stock market, trigger volatility, and change how we all look at investing. Think about it. When was the last time we saw something like this? And more importantly, what does it mean for you? The real question isn't if the market will move. It's when and where it'll go once it does. Will it be the relief rally everyone's hoping for, or the crash nobody's prepared for? Stay tuned, because the answer might surprise you. Here's where it gets really interesting. The bond market isn't just quiet for no reason. This tight range on the 10-year yield, it's a classic signal that something big is coming. And it's not just speculation, it's backed by patterns that have played out time and time again. Take a look at what's happened every time we've seen this kind of stillness in the bond market. A sharp spike in yields. And if that happens now, it could send shockwaves through the stock market. We're talking about a potential spike to 4.4%, maybe even 4.5%, numbers that would make investors sweat. But here's what no one's saying out loud. This could happen while the Federal Reserve is still in the middle of its rate-cutting cycle. A complete contradiction. The Fed's actions on short-term rates could be working against the bond market's long-term pressures. This is where it starts to get uncomfortable, and that discomfort is exactly what could trigger the next big move. Now let's talk about how this situation escalates. This isn't just about bond yields or stocks. It's about the entire system under pressure. When you see this kind of quiet in the bond market, it's usually followed by a dramatic shift that affects everything. We've seen it before. The last time yields moved this way, it wasn't pretty. The stock market dropped and global economies felt the sting. And that's exactly what's at stake here. This quiet period, it's becoming the new normal, and that's the real danger. We're getting used to something that shouldn't be normal. Yields staying so low for so long while the economy faces massive uncertainty. That's unsustainable. Something's got to give, and when it does, the impact will be felt across every corner of the market. The question is, how bad will it get, and who will be left standing when it all shakes out? Here's the kicker. The evidence is stacking up. And it's even more alarming than what we've seen so far. If you think this is just a blip in the bond market, think again. The tension is building and the cracks are starting to show. We've already seen the contradiction between the Fed's actions and the bond market's pressures. Now it's starting to play out in real time. Take a look at what's happening on the S&P 500. Yesterday, the market looked like it was going to surge. The AI sector was pushing higher, and then boom, the market turned around. A perfect opportunity to break out. And yet it didn't. That's the kind of behavior that sets off alarm bells. It's a sign that investors are starting to back off. That pause, it's a red flag that tells us things could get ugly fast. Now notice what's missing here. Nobody's talking about this weird shift. Everyone's caught up in the latest rally, but the signs of exhaustion are already there. Here's where things take a sharp turn. In the last 24 hours, we've seen several related developments that suggest the market is losing control. First, we had a slight rally, but it quickly fizzled. Then we saw the trend line on the S&P 500 break, briefly, but enough to set off a chain reaction. It didn't confirm, but the pressure is mounting. And then there's the silver market. This one's even more interesting. Silver had a massive drop, followed by a bounce. The same pattern we're seeing in the broader market. It's a classic case of things breaking down, testing new lows, and then snapping back. But how long can it hold? This isn't just a minor setback. These signals, all happening at once, point to something bigger on the horizon. What happens if this continues? If the market keeps pushing down and doesn't recover, we could be facing a much deeper correction than anyone is predicting. Now let's shift gears and talk about the real-world impact. This isn't just about charts and trends. It's about people like you dealing with the fallout. If you're an everyday investor, a small business owner, or someone planning for the future, this sudden market volatility hits home, because when yields spike, stocks tumble and uncertainty rises, it's not just numbers on a screen. It's retirement savings, job security, and your ability to invest wisely. Take a moment to think about what this means for regular folks. Higher borrowing costs, shrinking investment opportunities, and increased pressure on everything from housing markets to consumer goods. If this keeps going, it won't just be the 1% feeling the squeeze, it'll be everyone. If this feels familiar, say so in the comments, because it's clear that things are about to change and the ripple effect will be massive. Now, let's go beyond the immediate chaos and look at the system behind all this. Why is this happening? It's not just random. There's a deeper mechanism at play. The market isn't just reacting to economic conditions. It's being shaped by the actions of powerful forces, leverage, incentives, and spectacle. Take the Fed, for example. Its role in controlling short-term rates is becoming more complex by the day. When its actions don't align with what the bond market is doing, you get friction. And that friction, it causes these massive shifts that affect everything: global markets, currency values, even international trade. The system is rigged to self-correct, but when that correction happens, it's often ugly. The truth is, the system is designed to keep this volatility in check, but it can't forever. When these pressures reach a tipping point, the entire structure could face a collapse. We're already seeing the early signs of this breakage. So, what happens next? There are two possible paths from here, and both lead into uncertain territory. One possibility is that we see a sharp recovery, as some investors hope, an escape from the storm. But here's the thing. With every sharp move in the bond market, the risks grow. A rally might look good for a moment, but it could just be the calm before a much bigger storm. A sudden shift could trigger panic selling, and the correction could be deeper and more prolonged than anyone anticipates. The other option? Things continue to deteriorate. The bond market moves, the stock market reacts, and the ripple effect spreads across the global economy. If we see a breakdown here, the consequences will be swift, but we're not sure yet which direction it'll go. What we do know is that the momentum is building, and both of these scenarios are highly probable. By the end of January, we'll have a clearer picture, but right now, every move could set the stage for a much larger shift. Here's the bottom line. We're at a crossroads. The bond market is telling us that something big is coming, but no one knows exactly when or how it will hit. What we do know is this: the next few weeks are crucial. If you're paying attention, you might just get a chance to position yourself before the big moves happen. And here's the real takeaway. The market isn't just going to fix itself. It's going to keep testing our limits. The question is, will you be ready when it does? If you want to stay ahead of the curve, don't miss what's coming next. Hit follow and subscribe, because this story is far from over. You'll want to be here when the next piece falls into place.